Welcome back to Managing the Insider Threat, what every organization should know. Next up is Randy Trzeciak presenting on insider fraud, illicit cyber activity involving fraud. Quick reminder for those of you using Twitter, be sure to follow at SEI News and use the hashtag CertInsiderThreat. And just a reminder for those of you coming in and out, we ask that you fill out the survey for your feedback on today's event, and also explore our materials widget so you can get all the presentations and technical reports related to CERT's work in Insider Threat. Randy Trzeciak is a technical manager of CERT's Enterprise Threat and Vulnerability Management team in the CERT Insider Threat Center. His team's mission is to assist organizations in improving their security posture and incident response capability by researching technical threat areas, developing and conducting information security assessments, and providing information, solutions, and training for preventing, detecting, and responding to illicit activity. Randy, welcome back. We know you presented this morning. Floor is all yours.
Thank you very much. It's good to be back. In this particular session, we want to talk specifically about insider fraud. If you remember back to the first session, we tried to communicate the fact that we believe that there is not one traditional or one type of insider threat. That particular session went through a couple of scenarios which really focused on the impact to the organization, but also the motives of the individuals themselves. So if you remember back to the definition as well, we went through and talked about insiders, the threats being your employees, contractors, subcontractors, and trusted business partners. This particular session will be focused on one type of impact being insider fraud. Going all the way back to the beginning, we talked about insider sabotage. Just as a quick recap, those particular individuals who sabotage critical IT assets, those are traditionally technical folks, privileged users with elevated, escalated access, and they impact the organization by disabling a critical asset being the technology. Those folks tend to be disgruntled, and they tend to set up their attack prior to leaving, and then the impact is seen after they leave the organization. So again, that's one of the types of threats that we described. That is different from theft of intellectual property. If you remember in the first session, we talked about individuals who take intellectual property primarily for a business advantage. They tend to take the information before they leave, and they use it for a business advantage being to get a job with a competitor, to start a competing organization, and in some cases take that information outside the U.S. to benefit a foreign government or foreign organization. Now, this particular type of incident we're going to talk about is insider fraud. These folks tend to be motivated by a financial gain. Those folks tend to do it while they are employed at the organization, and they tend to do it as part of a normal day-to-day business activity. So that sets the context for this particular session. This particular session, we want to go through a specific research study that we conducted from 2011 through 2012. That particular research study was funded by the U.S. Department of Homeland Security Science and Technology Directorate. So DHS S&T funded the study, and they asked us to specifically work with the United States Secret Service. The Secret Service provided information in terms of recent incidents that they've collected and investigated, and the crimes that they've investigated occurred between 2005 and the present. And really what we were looking for is if we look across the incidents to, again, try to develop patterns of activity, both the technical patterns and non-technical patterns. The specific cases that were provided were 80 in total. The majority of those were insider incidents, but we did have a few subset of the cases being where an external party was involved as well. And really what we want to be able to do is this particular study is to give some type of insight and risk indicators to help both private industry, government, and law enforcement, again, looking at the prevention, detection, and response and investigation when trying to mitigate insider threats. So again, this particular study, again, was funded by the Department of Homeland Security Science and Technology Directorate. So I will point you to our website at the beginning as well as at the end. This particular study did result in 2 publications. We have an executive summary, Insider Fraud in Financial Services, which you can download from our website. And there is a detailed report, specifically about 70 pages of the study itself, talking about the methodology, insider threat study, illicit cyber activity involving fraud in the U.S. financial services sector. So again, please go to our website to download the most recent versions of these reports, as well as find additional information about fraud in general and other types of incidents committed by insiders. So let's set the definition. Again, we talked at the very beginning of a need for an ontology, a way to define insider activity. We want to set the stage in terms of malicious insiders. So again, this is focused on the fraud activity. Same definition we talked about earlier this morning: current or former employees, contractors, and other business partners, and they impact the organization. Impacting primarily being looking at the integrity of data or the confidentiality of data and or systems. The motive of the insiders who commit fraud obviously is for some type of business advantage or personal advantage, or in some way they will benefit monetarily from the additions, deletions, or the data modifications they make in their critical systems. When we look at the fraud activity, again, we're really focused on this particular study being the use of information technology. These would not include crimes where there'd be some cash theft or something that would result in physical theft of something. It really is focused around the use of IT, and it was for some type of personal gain or theft of information leading to some type of identity crime. One of the findings and recommendations that we'll talk about is the actual target of these particular crimes being personally identifiable information. And just because you may not be in the industry of a banking or a financial institution, we do believe that most organizations do have some type of PII which they're in the business of protecting. Whether that be your own employee data or whether it be your customer data, keep in mind that that could be a potential target from someone in your organization with authorized access to take that information off of your network or systems, and they could benefit financially by selling it on the external market, whether that be for some type of identity crime or some type of credit card theft or et cetera. So that's the scope of this particular study itself. Insider fraud being the use of IT and the individual benefits financially. Again, to differentiate between the other types of crimes that we talked about earlier this morning. So these particular findings, 6 findings, which we'll discuss at a very high level in this particular session, can be found in greater detail in either of the reports which we discussed a couple minutes ago. But really what we want to focus on is the 6 findings as well as some recommendations that organizations can do to prevent or detect fraud in the future. The majority of the organizations that were involved in these particular incidents, the victim organizations, were primarily in a banking and finance industry. The industry certainly includes retail, commercial, investment banks, accounting firms, credit card issuers, credit unions, but it does expand beyond to include insurance providers or other organizations that do have a financial department, such as retail business, whether it be an automobile dealer, some type of building or home improvement type stores, employee benefit providers, staffing, engineering, retail, transportation, and really those would affect from the federal, state, and local governments itself. So that's the scope of what we were given in terms of the data set. What we want to do is analyze these 80 specific incidents and then combine it with our previous 12 plus years of research when we try to describe what insider fraud looks like, both in terms of the technical observables and the behavioral observables. So let's get right into findings. Again, there are 6 findings as well as some recommendations. So in terms of finding 1, again, the 80 cases that we analyzed, traditionally we would describe one of the findings being a lower and slower approach to the crime itself. The criminals who executed this low and slower approach, they tended to accomplish it and it had more damage and had a longer period of time where they were not detected. So that might not sound that earth-shattering in terms of a finding, but one of the things that we do want to look at is what we describe here in the chart. When we look at the chart and we look at it from left to right, it's a timeline of activity. A couple of points of interest when we did the analysis of these 80 cases, if we start from the time that an individual was hired in an organization until the first data point moving to the right when the fraud starts, on average across these cases, it's approximately 60 months or over 5 years of an employee being in the organization before they begin their fraudulent activity. So these are trusted employees within the organizations committing fraud. Now you can speculate a number of reasons why it's at that period of time. It could be that individuals are collecting knowledge about what the fraud controls are, what the detection strategies are, or it could be that individuals are progressing through the organization and gaining additional privileges and accesses. That certainly could be the case. But what we want to be able to do is to combine that with some of the motivations of the insiders, people who committed fraud. As part of this study, we were fortunate to be able to collect information of the fraud activity itself, but also we were fortunate enough to be put in contact with the investigators from law enforcement. We interviewed a number of people for each of these cases. One of the common themes across these cases was the number of individuals who committed fraud that actually had some type of change in their financial status, whether that be personally or professionally. And what we mean by that is that there were a number of financial stressors or financial issues that may have contributed to an insider's decision to defraud the organizations. A couple of the financial stressors that are documented in the reports would be medical bills, divorce, a change in employment status, which would be a reduction in pay with an organization. Think about it from an organization standpoint. Individuals who may have some type of financial need may consider fraud as a way to overcome that particular financial need. Certainly not all employees. Again, this is a low base rate event. Not all of your employees by any means are going to commit fraud, but if we look at the fraudulent activity, there are patterns that you could observe. So first takeaway I want to ask you to consider is the employees that are trusted employees within your organization. Many organizations on a regular basis will screen employees prior to employment, but consider, do you do anything different from the time an employee is hired to the time that they are employed with you as an organization? Might be something to consider. Are there ways that you can detect someone's financial need? If so, you might want to make that part of a periodic reinvestigation process. Again, not all people who have financial need are stressors. And if I asked anyone out there in the community, how many of you are not under financial stress, I'm sure the answer would be relatively zero or very close to zero. Most people are under some type of financial stress. But again, from a standpoint of being one data point, that might be one thing you want to consider as someone who may be more likely of committing fraud within your organization. So again, the data point, trusted people, 60 months from the time they start with the organization until they start their fraudulent activity. Now let's go from the next data point, from the time the fraudulent activity starts until the time it's detected. 31.8 months, so over 2.5 years from the time that the fraud starts until the organization detects it. If we start looking at some of the data points across what we're considering some of the detectable activity, there's only a number of activities that could have been detected by the organization. So on average, if we looked across these cases, there were 132 fraud events that could have been detected by the organization. In these particular cases, they weren't detected until 2.5 years after the fraud starts. The case that was of the most detectable, if we take a look at those fraud events, there was one case where there were 756 fraudulent events that could have been detected from the time it started until it was actually detected. So if you look at it from a glass half full standpoint, there are possibly lots of detectable activities. Half empty, why is it taking 2.5 years from the time it starts until the time it's detected by the organization? So again, putting in controls in place that could detect the technical activity with some of the motivations might allow you to identify people who may be more at risk. So from the time it was detected until they were fired or terminated from the organization, next to or very close to zero. So you detect someone's committing fraud, most organizations will fire them almost immediately. And here's another key point as we look at this. From the time that, on average, the people are fired or terminated or detected until the time that law enforcement is notified, almost 5 months elapse in between that activity. As part of this research study, we were fortunate enough to present these findings in conjunction with the United States Secret Service. We went out to their electronic crime task force meetings. We presented the findings, and we actually were attempting to solicit recommendations or feedback on the study itself. One of the recommendations from the Secret Service perspective is that they would like to see that number get closer down to or closer to when the fraudulent activity is detected. Ideally, they'd like to make that less than 4.8 months. Again, from a standpoint of law enforcement being involved, there may be a number of reasons why you would not involve law enforcement. A number of the reasons that we heard would be fear of negative publicity, or if there's not a need or requirement to report, some organizations may not report, or if the impact of the organization does not outweigh the amount of time and effort and money to prosecute, that might be a cost-benefit decision made by the organizations themselves. But again, these particular cases, about 5 months from the time law enforcement was notified. So again, these cases did involve law enforcement. So again, they're certainly suggesting that they want to try to make that closer to when you detect it. They have the expertise to do this over and over and over again. And certainly from a fraud perspective and fraud investigation perspective, They can help you and assist at protecting critical information as part of your investigation process, certainly the evidence that might be required. So certainly the recommendation from the Secret Service perspective is call them in as quick as possible, or even inquire on what the process will be if you're even considering law enforcement being notified. So then from the standpoint of the last data point on the slide, law enforcement notification to conviction, about 16 months, and really that just is the time that the U.S. court system has from bringing it to court and actually convicting itself. So a couple of data points here, a lower and slower approach. Keep in mind that these individuals are motivated by financial gain. So the longer the crime or the fraud event happens, the more money they will benefit. So here's the challenge for you as an organization. Can you identify certainly the high events of a large fraudulent activity? The person who attempts to steal hundreds of thousands at one particular interval, or even more than that in some organizations. Can you detect that? Most organizations would most likely say they could detect that. But what about the lower and slower approach that over time it adds up to or hundreds of thousands of dollars, but any one fraudulent event was measured in thousands, or smaller amounts that are under your fraud detection strategies. So the challenge is, can you do the large events as well as the low and slow? That's what we would have in our recommendations at the end of the presentation. What we want to be able to do is to give some examples of the cases that we actually were involved with the analysis after the fact, to try to tie into the recommendations as well as to the findings for each particular finding. In one particular case, there was an accountant at a CPA firm, had very good performance over the years. As you can imagine, good performers tend to be migrated up in an organization's hierarchy. They tend to get additional privileges as they go up as well, or additional responsibility. This particular CPA had sole responsibility for one of the accounts for two of the company's clients. And what she was able to do was to create fake employees on the payroll of one of the companies, and over a period of 6 years paid herself over $100,000. How it was caught, it wasn't caught by the organization itself. It was actually caught by the two client companies. They identified large amounts of cash missing, and then that started an investigation going back to the victim organization. The consequences, as you can see here, she actually pled guilty on charges of wire fraud, check fraud, sentenced to 15 months in prison and 3 years probation. What's interesting in terms of the last part of the sentence that's under the consequences is she was ordered to repay the remaining $77,000. If you look back to the crime itself under that bullet, $100,000 was stolen. This particular individual had begun paying back the $100,000 that she embezzled from the organization, and at the time she was caught, she had a balance of $77,000. So again, doesn't justify the need for or the idea to commit fraud, but she actually had begun to pay it back. And that was a common theme when we actually went through the investigators of the particular incidents. They tended to, when talking to the people who committed the crimes, a lot of them used the rationale that they would do it to overcome a short-term financial need. Again, that may have been just after the fact. It might have been part of their justification or rationalization, but at least this one particular case, this individual did start paying the money back at the time she was caught. So finding one, a lower and slower approach. Again, we have 6 of these findings. Finding 2, a very low technical approach to the crime itself. Insiders means we're not very technically sophisticated at all. Again, about 65 of the incidents, 81%, very much in terms of non-technical subjects, didn't need technology to carry out the crime. So about 80% non-technical in nature. Again, that might be something that's not surprising itself at all, keeping in mind that when we describe the people who commit the crimes, these are individuals who are involved in a business process. They've authorized access to the applications and systems. They can add the customers. They can modify the customers. They have the ability to modify or be involved in a business process. So here's a challenge for you as an organization. Can you detect a transaction that has malicious intent? Very hard thing to do from a technology alone standpoint. If I, as a person working in a financial institution, I'm responsible for adding 100 new customers. But what if the 88th customer that I add that day is an unauthorized transaction, that it could be for a family member or someone that I'm working with outside the organization? Can your technology identify a transaction that has malicious intent? Hopefully you can do that. But what we found is that many organizations aren't able to differentiate between an abnormal transaction and something that could be considered suspicious. So the challenge is can you detect these low-tech crimes, traditionally using some type of application, and are your fraud controls in your applications able to identify or flag suspicious transactions? Now, I would caveat this particular finding with the caveat being that these are the people who were caught. Again, we were given 80 cases of people who were caught. It could be that the very technically sophisticated fraudsters aren't being caught. So keep that in mind when we describe this particular study. The data we have is the people who were caught. Looking at a case example that would demonstrate some of the non-technical nature of the crime itself, if we take a look at one particular case being a vice president at a credit union was given a corporate credit card for business purposes. They had a corporate policy that said you can only use the credit card for business purposes. Again, that typically wasn't enforced through any type of technology. It was a process that was in place, something that was clearly communicated. This particular individual, the vice president, used it for non-business purposes. He used it to pay personal expenses, cash advances. Again, from a standpoint of using the card, that might be hard to detect. But what could have been detected was when he created fake invoices on his laptop, created a fake contract with his wife's third-party organization to pay for the fake services via the wire transfer. So again, some of this is non-technical, some of it might be hard to detect with technology, but when you start going through that audit process, we believe that these are some of the things that could have been observed by the organization. Certainly the fake invoices, the creation and submission of these fake invoices might be something that could have been detected. So finding 2, very low technology in terms of the people who were caught in this particular study. Finding 3, managers versus non-managers. This is one of the findings that we found most interesting in the study itself. Most interesting being that we've been doing fraud research since about 2001. So we're about 12 years worth of fraud incidents we've collected. Prior to this study, we tended to describe fraud being lower level employees in jobs that were using applications, and they were able to get through the fraud activity using a predefined business process. So again, we define these as help desk employees or people in a business process. What was interesting about this particular study was that over half of these newer crimes that were investigated by the Secret Service had the manager, someone in a trusted position, being involved in a fraud itself. So we need to go back and modify our description of what fraud looks like in terms of who does it to be the lower level employees, the data entry folks, the help desk folks, but in addition, consider managers or someone in a trusted position who's potentially involved in the fraudulent activity as well. So again, about 50% or slightly over 50%, a manager or a position of trust was involved. So if we broke that down a little bit in terms of the impact of the organization, this particular chart shows the impact if it's committed by a manager versus a non-manager. And we show you here the average and the median. When we take a look at some of the data at a whole, we start looking at the averages being significant when managers commit the crimes. Over $1 million on average impact to the organization. And that's compared to on average about $300,000 for the non-manager, so significantly increase when a manager is involved. We went back and did some analysis of the data. We found a couple outliers, which is why we present the median here as well. So if we look at the median, looking at the impact of the organization, it's still about 2 times the impact if a manager is involved in a fraudulent activity. These details, these findings are documented in the reports. Feel free to go and take a look at our data, our sample, and the statistics used to generate these particular results. So the question here is, the challenge for you as an organization is, are you doing anything to attempt to identify fraud that might involve someone in a trusted position? When we start looking at the differences or the similarities between managers and non-managers who carry out the crime, a couple of things of interest. The perpetrator in the manager scenario typically are branch managers or vice presidents. What we found is that those particular individuals are in a position of trust. They tend to migrate up through the organization into that position of trust. In a couple of the cases, we found that the individuals found they were able to alter a business process, including involving other folks, whether intentionally or unintentionally, the subordinate employees in the particular incident or the crimes themselves. So think about that from a standpoint of the manager-subordinate relationship. Are there any managers influencing other folks in the organization to be part of the incident whether it be intentionally or non-intentionally from a standpoint of being socially engineered. So something to consider. Are you able to detect if the fraud involves someone who may be involved in the detection of the fraudulent activity? So that's the manager scenario. If we look at the non-manager scenario, again, these typically tend to be customer service representatives, those folks who had authorized access to a business process. They can alter accounts or steal customer accounts or other personally identifiable information, the victim organization, and typically for money. So think about the two different scenarios. Your detection strategies might slightly be different if you're looking at the business process or the detection process from a manager or a trusted partner in the particular organization. If we look at the comparison of the fraud by managers versus non-manager, you can see some of the stats here in terms of the number of cases. When we start looking at the managers being the branch managers, vice president, that's a little bit different from your help desk employees or your accountants or your bank tellers. Think about it from a standpoint of someone who's involved in your business process. Tends to be your non-managers. You can see the age differences here. Age might not necessarily be something of concern. If you think about managers being people who are trusted employees, been with the organization a little longer, age probably is not an identifying characteristic of someone who's going to commit the fraud. Certainly from a timeline standpoint, the extended duration, if we take a look at the difference between the fraud committed by managers, tend to be longer in terms of the activity. Again, their knowledge of what your fraud controls are, your detection strategies are, might allow that incident timeline to extend comparatively short to a non-manager involved in the fraudulent activity. Certainly, if we take a look at the origin of trust, the period of loyal service from a manager perspective, again, these folks have the ability to know what your controls are. So the challenge is, are you able to identify potentially suspicious activity if it would involve a senior executive in your organization? And certainly you can see from other criteria, when we start looking at the outsider facilitation, the concealment, both in terms of the concealment method, most tend to just fly below the radar. In many of these cases, the individuals knew exactly what the fraud threshold limits were, avoided detection by going slightly under that particular detection strategy. If we wrap this particular finding up, managers versus non-manager, this is the specific non-manager breakdown. We broke this down into the accountants, customer service, technical positions, as well as analysts. And here you can see the amount of time, the average impact, as well as the median impact to the organization. Both in terms of the average being average by month, average total, and you can see that significantly increases when we start looking at the accountants. So the challenge here is, are you able to have some type of dual control in any business process from a non-manager standpoint? When we look at the managers, do we have someone watching the people who should be watching for the fraudulent activity? Again, many of these things aren't surprising to those of you in financial institutions. It's certainly recommendations that we would make, and you're certainly well aware. But the challenge is that when we have the ability to detect it, are you consistently detecting it as quick as possible? Given the fact that many of these individuals might know what you're looking for from a fraudulent activity standpoint. A case example here, we had to demonstrate this particular case. A loan processor at a banking institution had full privileges to read and modify loan information. This particular individual took out 2 legitimate loans. They're authorized to have the loans, $39,000, but basically what she did was increase her personal loan amounts, withdrew the difference, thereby committing embezzlement. Impact to the organization, about $112,000 was stolen. So challenges here from this particular case example would be, can an individual have an authorized loan? The answer is yes in terms of the policy. Can an individual who has authorized access to your business process modify his or her own information in the critical systems? Hopefully the answer to that would be no, if that's a scenario that you would consider within your organization. Finding 4, again, remember there's 6 findings. The amount of collusion. Most of the cases that we involved did not involve collusion. And when it did, it was traditionally with someone on the outside of the organization. So again, from a standpoint of the glass half full, hopefully many of your organizations are putting some type of dual control or separation of duties in your business process. Again, that's a well-defined way to prevent some type of activity. What we're finding is that the crime was still able to be committed without collusion occurring. Some of the hypothesis we have, and we've seen this over a number of years of talking to the organizations, some organizations tend to let privileges accumulate over time. So for example, if I'm in a bank teller position and I get promoted to a manager position, do you do anything to restrict the access from one role versus the other? Unfortunately, many of the organizations we talk to tend to let the privileges accumulate over time, therefore allowing them to bypass some of the separation of duties which are explicitly put in place to prevent that activity. So the challenge is that we would ask you as an organization, are you confident that your employees only have the privileges you need to do the job, but not more that might allow them to bypass some of the controls you might have in place? Something to consider. Finding 5, audits, complaints, and suspicions. Again, finding 5, how was it detected? How did they detect the fraud? Even though it was after 24 months or 2.5 years, how was it being detected? Most of the incidents were detected through an audit, customer complaints, or coworker suspicion. So do you have the ability to collect information through an audit process? I would expect most of you would answer yes to that. Do you have the ability to collect information from customers? I would hope that would be yes as well, but also coworker suspicions of the activity. Hopefully the answer to that's yes as well. The most common ways these attacks were detected were through routine or impromptu audits. Again, maybe not surprising, but we do want to highlight the impromptu audits. A number of the folks that we were fortunate enough to interview over the years, when we start looking at how we collect data, a number of the individuals were detected through impromptu audits. The predictability in your audit process might be one of the things that people are collecting to determine if and when fraudulent activity could occur. So the challenge is, can you have some unpredictability in your audit process, both in terms of when it's happening, but also in terms of the amount or the threshold you're looking for to identify suspicious activity. Over half the insiders were detected by other victim organizations' employees, although none of the employees were in the IT staff. And that might be interesting from your standpoint. It was from our standpoint. We want to combine that with, in conjunction with, only 6% of the cases were identified with software or systems that are explicitly used for detection purposes. It seems to indicate that fraud detection technology was either ineffective or not present. We do want to caveat that with the fraud detection software and systems might do a very good job at prevention, which did not allow it to happen, which then it would not be able to detect it in these particular cases. So the fact that you're relying upon IT systems alone, you might want to consider a dual strategy or the defense in depth strategy to use in conjunction with your software or detection systems. As expected, most of the initial responders to the incident were managers or someone in internal investigations. And finally, the last finding we have, finding 6, personally identifiable information. And here's where we can make the leap outside of the financial community. As I said at the very beginning, most organizations collect some type of PII. Target that from a fraud standpoint, whether the PII be for your employees or about your employees or the customers that you're protecting information on. So have you considered that being a target? Hopefully you have. Hopefully you identified that as a critical asset you want to protect. And are you able to protect it from exfiltration off of your network to be used for some type of identity crime, credit card theft, etc.? So when we look at the PII, it's certainly interesting from a standpoint of the usage, the number of cases we have, but also from a standpoint, here's where we can make the leap outside of just specifically the banking and finance community. So 1 through 6, we presented 6 findings. As I said, each of the findings are detailed and much more information is available for each of those in the reports that we pointed you to at the beginning. So we presented 6 findings. How about some recommendations? So certainly when you prevent fraud after an incident, evaluate the fraud and ask yourself the following questions. If fraud happens, do we need to do anything to change our business processes? Hopefully you have that as part of your enterprise-wide risk assessment. Think about it from a control standpoint. You want to prevent any similar activity in the future. And to the best of your ability, try to automate as much as possible some of the scripts that might be available to detect similar activity. Again, with the automation, those tend to be more consistent. You're able to do those on a more economic scale, and you might be able to do those on a more frequent basis rather than having physical people go through the audit process. Okay, what you can do from a standpoint of what we can do. Certainly I pointed you to the documents. Insider fraud and financial services, that is the executive summary. It's about 20 pages, just giving a high-level overview. If we look at the more detailed report, the Insider Threat Fraud Study, that's where we get into much more detail. That's about a 70-page report. It'll go through the research methodology, go through the detail, go through the statistical analysis, etc. We do want to point you to our common sense guide to the mitigation, prevention, detection of insider threats. That was one of the sessions that we talked about earlier this morning. It gives much more detail, but we have a guide available on our website. Our website is up here, the Insider Threat Center, cert.org, insider_threat, and there's specific links to the fraud report on our website. And consider these following strategies as well. Policies and controls. Certainly policies and controls are important. Clearly communicating the policies of what's expected of employees and what the activity that is considered suspicious. But balance that with the need for employees to know everything that's going on in your fraud detection strategies. The idea is that you want to consistently enforce the clearly documented policies. And add to it, do you have the ability to have some unpredictability, the inconsistent monitoring and auditing of transactions? Here's where we have the ability to try to identify suspicious activity without the consistent threshold setting that insiders might know of, that it might allow them to go under the radar, the low and slow approach. So consider your policies and controls. Also consider your security awareness training. You can debate the effectiveness of security awareness training, but it will give you the opportunity to communicate what's expected of your employees. Communicate with them what are the consequences of suspicious activity or the infractions. And here we want to get specifically to the fraudulent activity itself. Think about also from a standpoint of if there was an external person targeting your employees, what could your employees be incentivized to do with your data that might make them part of a scheme where they will be paid for the fraudulent activity? Again, the definition of fraud as we define it is not only the theft of money, it could be paying someone to add or modify or delete data. The example we used at the very beginning of the session today would be someone who's paid to generate identity documents, or paid to grant benefits, or paid to change some type of history about employees. That is fraudulent activity as well as part of the normal business activity. Consider your employee reinvestigations. Do you have an employee reinvestigation process? And that might be just for specific people in your organization. Certain roles in an organization, certain positions, you might want to consider a periodic reinvestigation process for employees in positions of trust. Think about it from a standpoint of if there is significant financial stress, is that something that you use part of your risk calculation on the part of your employees? Keep in mind that that needs to be bounced off against other employees who also might be under financial stress that might not be in a position of trust as well. As I said, I'll challenge many organizations to identify a number of people who are not under financial stress at any point in time. That does not say that those people under financial stress will go on to commit fraud. Think about the unexplained wealth or living beyond their means. That might be, again, one thing you might want to consider, certainly in certain positions of trust within your organization. Certainly we don't want to create the culture of distrust, but also certain employees might have additional privileges based upon their roles and responsibilities in the organization. Then let's get on to the online activity. Do you have the ability to log activity? Most organizations would answer that yes. They can log everything, but try to be more proactive, alert when an activity is happening. Logging is good, but that's typically after the fact to prove that someone did something. But do you have the ability to identify when something suspicious is happening? And can you alert on that activity, which moves you from reactive to be proactive? Also consider certain technologies. There are SIM tools that are out there. There are data leakage tools that are out there. Think about what you're trying to protect. Think about what you want to identify as suspicious activity, and certainly look for tools and controls that are out there today. Think about your positions of trust. Think about your accountants and managers. Certainly we want to pay special attention, in some cases, to your accountants and managers. Do you have the ability to check the checker, the person who's responsible for identifying the activity? Do you have some type of dual control or separation of duties in that detection process? And certainly think about the unpredictability into your auditing function. We talked about it a number of times throughout this session. Might be a way to identify something that's suspicious rather than having the predictability of when the audits occur, but also what you're identifying as suspicious transactions. Also consider the personally identifiable information as a target. Again, many organizations have personally identifiable information, if nothing else, on your employees themselves. Are you protecting that? Are you identifying that as a critical asset to protect? And we talked about the idea of accumulation of privileges. Don't let the privileges accumulate over time. Ask your IT department, ask your business owners. Do people who have authorized access to the data and transaction only have the privileges they need to do their job? Appropriate to the job privileges, but not more than they need. That's certainly when we want to alert. We want to be able to identify when, if you're looking at the target, when your PII is accessed, certainly when it's modified or when it's transmitted. And that might be part of an alert function that you might want to institute within your organization. And then finally, an insider incident response plan. Certainly you do want to have a clearly communicated and documented insider incident response plan. It needs to be clearly communicated, and you don't want to be asking yourself, when you identify the fraud, what do we do? Try to be have some forethought in that process, define what the process will be, who's responsible for what actions, who's responsible for carrying out the plan, and certainly have a feedback loop in that process which will identify lessons learned. The goal is to continue to improve your plan going forward. So here's the strategies for insider fraud mitigation. Compare and contrast that with the 6 findings we presented at the beginning. And certainly we would recommend your feedback and input going forward. As I said at the beginning of the session, given that we're a federally funded research and development center, we do want to work with you on an operational standpoint. We do want your feedback. We want your input with directing how we go and future directions of our research. So if you're interested, please contact us, the Insider Threat Feedback alias. We certainly want to recommend your feedback and input for this particular study, but also additional ways that our research can be tailored into the future. So with that, I'd like to open up for question and answer. Be glad to take any questions you have out there.
Okay, before we dive into questions, I'm going to mention this one more time just because we're getting this question a couple times just about slides, and to remind everybody that there is a materials tab on your console. Click on that. You'll see all the slides in PDF form there that you can walk away with today. So first question for Randy from Robert asking, are there categories of tools that may be effective for protecting information?
Yeah, there's certainly categories of tools. If you take a look at the protection of information, really focus on protecting the asset. If you're looking at electronic assets, there are tools that can protect the assets. Now, one of the examples we had in one of the previous slides would be the DLP type tools, the data loss prevention tools. If you're able to identify a particular critical asset, data loss prevention tools could identify where the data is going, when it's leaving your network, and could even prohibit data from leaving your network. That would be one category of tool. Again, focusing on a critical asset, the electronic asset. Other categories of tools, if you want to consider other types of strategies, such as, obviously we talked about the DLP, but also the digital rights management, might be another category of tools, which only allows an asset to be accessed anywhere, but actually identified and used on your network and only on your network. Second category of tool. Other categories of tools, you can use protection strategies such as encryption, and encrypting data to only make it available to certain people who have the decryption key. And certainly when you think about the encryption strategies, it should be encryption data at rest, but also data in transit. So think about that in terms of other strategies. And there are a number of other protection strategies, particularly when you start getting into physical protection. There's a whole other categories of strategies for the physical protection of assets, which is somewhat outside of this study. But again, we want to protect the facilities as well as the information and technology as a broad perspective of protecting the information assets that are housed within an organization.
Okay, now we do have a hard stop in about 2 minutes to get set up for the panel, so we'll get one more question in for Randy from Todd asking, what suggestions do you have for sharing information across the organization, of course related to insider activity?
That's a great question, and certainly one of the strategies we recommend is sharing information across the organization. You certainly want to be able to consult across your organization to include your legal and contracting departments. When we start looking at the general counsel, make sure at the root of what you're doing, you're protecting the privacy of your individual, as well as what you set in terms of the expectation of privacies on your systems. If you have the ability to work with your general counsel, we recommend that you would work with your HR department. There's a wealth of information that could be used to identify someone who may be more at risk of this activity. Work with your physical security departments, but also work with, if you're working with contractors and subcontractors, your legal and contracting departments, And also think about your data owners. Again, these might not be the technologists managing the technology, but really the ones who are using the data, responsible for the data, determining roles and responsibility and access to your critical systems. We do recommend that those different departs be included across your organization, and really want to discuss that at the broad level of including different parts of your organization, and try to share the information you can to give a better perspective of who may be more at risk. Again, this is a low frequency event, but the impacts could be significantly high when you start talking about the financial damage or the damage if someone were to sabotage a network or system or really steal the intellectual property from your organization.
Randy, great presentation. Thanks again.